as you probably know, the stock markets go up and then they go down. And this usually lasts over many, many years. Now, it's hard to know when they're going to go up or down, as I've done some other videos about. But there was this really smart guy that worked at Merrill Lynch, and his name is Bob Farrell, and he is an analyst that wrote 10 market rules to remember that are really fantastic, and I wanted to share them on my blog, which I did recently at retirecertain.com. And I wrote some detail under each one, and I thought I'd make a video telling you these 10 rules so you can be aware of these rules. I think it makes a lot of sense to take a look at the rules during those times when it seems like we may be headed into extreme territory, when the market's been going in one direction for a number of years. And so without further ado, here they are. Okay, the very first rule is that markets tend to return to the mean over time. Now, a mean is simply an average, and I've got a graphic on this on my website, but it simply means that, you know, there is an average, and the market will move up away from that average. The performance will move up away from that average, that long-term average, and then it will move back below that average, and it corrects. It's constantly, gradually correcting and moving toward that mean over time. And so graphically, it's really something that gives you a lot of perspective. And if you have a long-term plan to invest your money in the stock market, it's much less important because you have plenty of time to wait out those long-term cycles and moves if you're a passive long-term investor. But if you're a little bit older, then you know, you maybe want to be a little more cautious about those cycles and avoiding those highs and those lows, because and being aware that the market will gravitate back toward that mean or that average. That's number one. Number two is excesses in one direction will lead to an opposite excess in the other direction. So we saw this after the correction in the early 2000s, and we saw it again in 2007 and 8. Well, the 2000 started in late 2007, the 2008 nasty bear market we had. And then for years after that, people avoided stocks, and it took real estate several years also to rebound and head back up and be in a cycle that was moving up. So those excesses of, you know, overvaluation in the markets leads to, or gradually goes the opposite direction. And so you can spot excesses when everybody's crazy about something and everybody has to get in on it, and then be on the lookout. So that's rule number two. Rule number three is simply that there are no new eras. Excesses are never permanent. So I remember at the end of the 1990s bull market, everybody was saying, oh, this time it's different because the internet is going to change everything forever. The technology is just going to change everything. It will never be the same. And it's sort of a joke about the market when people say it will never be the same, because it is the same. There are no new eras, and history tends to repeat itself over and over. And the fourth rule from Bob Farrell is market rule is exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. So, gosh, I've really noticed that cycles last longer than I think they're going to. And I've read that many times over the years, and I've found it to be true. As you know, being a personal investor, I've noticed that I get cautious, or I get maybe, you know, eager to enter into markets And I've noticed that they last, longer than you think that they are going to last. And so that's something to remember. And after they've had that steep fall down or that rise up, then they don't change by going sideways. They've got to go up or down to get back to that mean. So all these rules sort of tie together in a really nice way. Rule number 5 is that the public buys the most at the top and the least at the bottom. Now, I have heard this rule for years, and I don't doubt it at all, because I know that individual investors tend to get caught up in the emotions of fear and greed, and that's what leads investors to make a mistake around their investing and selling at the bottom and buying at the top. I wonder though now if it's not a little bit better with the availability of information for individual investors and the awareness that individual investors have gotten through all the information that is now easily available with the internet. So, as a general rule though, individual investors do tend to buy at the top and sell at the bottom. Rule number 6 is that fear and greed are stronger than long-term resolve. And again, that goes back to what I was just saying. Fear and greed, the emotions of fear and greed, they influence our investing decisions, and they sort of supersede or override our long-term plans. Now, I'm not always an advocate of long-term investing without any awareness of what's happening, or any consideration, I should say, of what's going on in the markets, because I think it helps to pay attention, because you can buy assets cheap after there has been a market correction, and you can ease out of markets when they are overvalued. That's how, what I think. But also, I think that the emotions of fear and greed can certainly lead investors to trouble. And so the important thing is to base decisions about investing on logic, on a solid plan, on facts, on what's going on in the overall markets. And so I think that can be worked around, but it takes absolutely some awareness of the fact that you may be letting fear and greed heavily influence, or help lead you to investing mistakes. And then rule number 7 is markets are strongest when they are broad, and they're weakest when they are narrow to a handful of blue chip names. Now, in the around 2017, 18, 2016, around that time period, an example of this would be the FANG stocks that we saw, Facebook, Amazon, Netflix, and Google. Right? They narrowly took the market up. They were so strong. They made up such a vast amount of that strong move up for years, that's what's meant by a really narrow market, whereas broad markets are healthier, and they tend to take all the stocks up together, as opposed to just a few that get hyped up and really overvalued near the end of a strong bull market. Another example I recall was at the end of the 1990s, when internet companies, a lot of them weren't even making money yet, that were just so overvalued, and there was just, it so took the overall markets up to crazy valuations, just that sector. So when the market moves broadly speaking, and all the stocks go up, that's a healthier market. Rule number 8 says that bear markets have 3 stages: sharp down, reflexive rebound, and then a drawn out fundamental downtrend. Well, that simply means that that this doesn't just happen all in one sort of fell swoop, that there are stages in a bear market, and it actually is sort of almost a logical stage, if you will, logical sequence, I should say, of stages, if you will. So the sharp down, is just that sharp down that we've seen as market investors. And during that drawn out fundamental downtrend, everyone's looking at the numbers and letting the market make sense again. So fundamental analysis is looking at numbers, whereas technical analysis is looking at charts. So that fundamental downtrend, that gives everyone time to evaluate and see, does the market make sense based on the earnings and the price that's going on right now? Where should it be? Where should these stocks be based on the fundamentals of the companies that make up the stock market? Then rule number 9 is when all experts, I love this one, when all experts and forecasts agree something different will happen. And you'll see this like the end of 1999 when everybody was saying, oh, this time it's going to be different. And the 2007, 2008 bear market that caught a lot of people off guard, even though we could see that the excesses were there in real estate. It hadn't been that long since we had had those bear markets in the early 2000s. So, but when people agree and say that something is going to happen, for example, in 2006, 2007, I remember experts that I highly respect, everybody was saying the market is going to go up, and something else did happen, in fact. Now, I think there are exceptions to this rule because I distinctly remember the end of the 1990s when experts were saying, we are not going to have a repeat of the next 10 years. In other words, we're not going to have a bull market like we had in the 1990s in the first decade of the 2000s. It's just not going to happen. You can't plan on getting the returns that you got throughout the 1990s again in the first decade of the 2000s. And of course, I guess everyone wasn't saying that. So, but it was a lot of people were saying it, and boy, were they ever right. And then rule number 10 is simply that bull markets are more fun than bear markets. I tend to agree with that because, you'll notice during bull markets, strong markets, it seems to me like everybody's driving new cars, right? At the end of or after a bear market for a year, 2, 3 years, everybody's driving used cars or older cars. I buy used cars, so I've got to be careful there. I love used cars. That's another video though. But everyone's driving their older cars, whereas you can see after a long bull market, everybody's driving new cars. It's more fun. There's more money. And the economy's strong, and there's just more prosperity. You can see more prosperity in just living. And but I do think there's one exception, and that is if you have extra money to put in the market at the end or near the end of the bear markets, then that's pretty fun to be able to buy into the markets when everyone else is selling. So that's what I wanted to share with you in this video. I've got lots more information on this and some charts and graphics at retirecertain.com. Go head over and read my blog there if this topic interests you. And I appreciate your watching. If you click the thumbs up below my video, I sure would appreciate it. Thank you.